Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Welcome to the channel, where we bring you the latest news and insights on the global economy, financial markets, and investment opportunities. In today's video, we will be discussing a topic that has been making headlines recently: OPEC's surprise oil production cut and its potential impact on investors. As you may know, OPEC Plus has decided to cut oil production by 1.16 million barrels per day, which has led to a surge in oil prices and sent shockwaves through the markets. We will be exploring what this means for the energy sector, the broader S&P 500, and the global economy. So, whether you're a seasoned investor or just getting started, be sure to stick around for some valuable insights. Before we dive into next possible crisis, which could be the oil crisis, let's do a recap of today's trading session. On Monday, U.S. equities started the week higher, with the S&P 500 gaining 0.4% and the Dow adding 327 points. The surge in oil prices was the primary reason behind the upward movement, after OPEC Plus members announced a surprise cut to production totaling more than 1 million barrels per day starting in May. The announcement led to a more than 6% increase in oil prices, topping $80 per barrel. The move is an effort by OPEC nations to lift prices and defend export revenues, having seen oil prices fall by more than 30% since last summer. While this move is not uncommon for the oil cartel, it comes at a precarious time, given the intense focus on inflation, which has been trending lower, in part thanks to lower energy costs. This uncertainty around oil prices could add to the list of anxieties that spark bouts of market volatility in the near term. Financial headlines were fairly quiet on Monday, leaving the markets focused on the broader narrative around inflation, monetary policy, and the implications for the economic outlook this year. Underlying performance didn't signal a particular undertone to the day's move, except for the jump in energy stocks. Sector leaders and laggards were a mix of cyclical and defensive areas. A weak manufacturing activity report underscored the latest economic headwinds, which was reflected in a downward move for both small-cap stocks and interest rates on Monday. Looking back, markets have done well in the first quarter of 2023, despite the bear market that began in January 2022. The S&P 500 gained a healthy 7%, its second consecutive quarterly gain, while bonds logged a 3% return for the period amid a drop in interest rates. This had the strongest impact on technology and growth stocks, with the Nasdaq rising nearly 17% in the quarter. Stocks are now 15% above their October lows, while 10-year Treasury yields are down more than 75 basis points, 0.75%, from their peak. According to experts, two straight quarterly gains signal that this bear market may be in its latter stages. However, they do not expect the rally to continue uninterrupted. A potential recession, political uncertainties, and shifting Fed expectations are likely catalysts for bouts of market indigestion ahead. Despite these uncertainties, experts believe the foundation of a new bull market will be poured as we advance through this year, supporting the case for opportunistic rebalancing within portfolios. OPEC Plus, a group of oil-producing nations led by Saudi Arabia and Russia, recently shocked the market by announcing plans to cut oil production by 1.16 million barrels per day. This move has far-reaching repercussions that could result in the S&P 500 reaching new post-pandemic lows. The immediate impact of the production cut was higher oil prices, with the price of WTI up as much as 8% following the news. It is currently confirming support at the $70 level, and oil analysts are already talking about the possibility of $100 oil. Looking at the charts and the demand outlook, $100 is a cautious target that might be reached within weeks. The International Energy Agency's March report is troubling, as it expects demand to accelerate sharply throughout 2023 and reach record highs before the end of the year. Demand is expected to hit 102 million barrels daily compared to February's 101.5 million BPD production rate. Take out the 1.16 MBPD OPEC Plus is taking out of the market, and supply will run just under 2 million barrels of oil per day short of demand. That will underpin the price action and could easily lead the oil price to new highs, given the onset of the summer traveling season. The IEA says increased air traffic and China's reopening are to blame. While the energy sector has been leading the market regarding earnings growth due to the rise in oil prices, expectations cooled off with the correction in oil prices but are now reinvigorated. The energy sector is expected to post a YoY earnings decline of nearly 20% for the year, but with oil prices rising, the consensus figures for Q2, Q3, and Q4 earnings growth should rise again. This means another year of windfall quality profits that will aid balance sheet improvements, investments in green and greener technology, share repurchases, and dividend increases. However, the broader S&P 500 may not fare so well. Energy is a leading input cost for all businesses and will cut margins, leading to another round of earnings growth revisions that could put the S&P 500 into negative territory for the year. The first half is already expected to see negative earnings growth of roughly 4%, while the back half should return to growth. The third quarter consensus is only 2.3%, with the year at 1.5%. It won't take much to get those numbers into negative territory, and then there is inflation to discuss. The rise in oil prices is most troubling for its impact on inflation. The oil price rise will re-accelerate inflation and leave world central bankers no choice but to remain hawkish. The FOMC said it would only hike interest rates one more time this year, but that is an unlikely event. Inflation is still high at over 4.5%, so the Fed must remain active until there is proof the fight against inflation is over. This means increasing economic pressure and the chance more banks will fail. The S&P 500 has been rallying, but that move is ending. The index is fast approaching resistance in the range of 4,100 to 4,300, and it will likely cap gains. The question is whether the market will reverse course, return to lower levels, or remain resilient and provide support within the 2023 trading range. A move to the 3,900 level is possible, and a move below may find support at 3,825, which is the bottom of the range. That's all we have for you today on the impact of OPEC's oil cut on investors. We hope you found this video informative and helpful in your investment decisions. If you have any questions or comments, feel free to leave them below, and don't forget to subscribe to our channel for more updates and insights. Thank you for watching, and we'll see you in the next video.